Attendees are in listen-only mode.
Good afternoon and welcome to today's Premium Account Market Update. The information prepared for general information traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hinde, current Managing Director of Global Equity Management and the Investment Manager for the Investor Signals Unit Trust, have 17 years of experience in the financial services industry as a licensed securities advisor. Today's format, we look at a quick macro update. We roll through the full ASX top 50 stocks. We review not only our broader portfolio allocations across those top 50 assets, we look at our recent transactions, discuss the derivative overlay that we're implementing, and conclude with a short-term Australian market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Moving straight into a graph of the US market, and we're just at the conclusion of third quarter earnings, and the takeaway is that US earnings appear to be growing at around 6.5% year on relative to the same time last year. If you put that in the context of where the market thought earnings were going to grow at the beginning of 2013, the market was looking for around 10% earnings growth. So we're certainly tracking a little bit below trend. One of the strong themes of the earnings season continues to be tight cost control, improving margins, but not a lot of top-line revenue growth. That's consistent with a broader macro picture where we're seeing relatively slow global GDP growth. The low global bond yields that are being manufactured by the reserve banks of the world are continuing to drive money, and there's a huge amount of cash still on the sideline, both at a corporate balance sheet level and at an individual level, that is yet to fully be deployed in financial markets. And I really think that's the centerpiece for what underpins equities, a combination of low global bond yields and strong balance sheets at a corporate level, and also a lot of cash within the investment market that's still sitting on the sideline. In the US economy, we're seeing better manufacturing data, we're seeing better housing data, we're seeing a better employment picture. Will we get a wind back in the stimulus program in March? Well, we'll wait and see. I think regardless, the US economy is going to continue to require some stimulus measures for some time to come, and they won't really fully be eased back until we see synchronized global growth, and predominantly that means that we need better growth out of Europe. So we're starting to see the early signs of the ECB provide GDP growth forecast in the order of around 1.5%, and that's from essentially zero growth that we've experienced over the last 12 months. But even that has been better, obviously, than the environment if you go back a couple of years ago in the Eurozone. We're starting to see stabilisation in China. Japan's contributing at the margin. So what we look for within US equity markets is, yes, from a forward PE standpoint, equities are expensive, but as I've spent a lot of time chatting, in an environment where bond yields are so low and money's forced into multinational, high dividend paying stocks, I think that theme continues to perform, albeit not with the strength that we've experienced over the last, say, 2 years or 3 years in the US. I think we get a prolonged period of consolidation, and it's only when we start to get synchronized global GDP that we could have another leg higher to the rally. So our base case is, and the downside risk fair valuation for the US market based on around about 14 times forward earnings puts the Dow back at about 14,500 points. What needs to be balanced against that is you'd expect the equity market to be higher as a result of historical low bond yields at the moment. So we're going to continue to see some premium priced in and some higher multiple than historical averages. We're sitting up in the range of, sort of depending on where you see forward earnings growth, anywhere from sort of 16 to 17 times forward earnings. So it is trending above average, but our base case is that yes, we could see maybe a 3-4%, even 5% correction in the US, but broadly it's well supported by some underlying earnings growth of around 6.5%, and the fact that we're seeing these low global bond yields. What that means for our domestic market is a similar type of situation where we're trading well above historical average PEs. We're tracking at about 15 times forward earnings, and that's on the assumption that we grow at about 7 or 8% earnings. I think for our market, we certainly sort of fair values back here at around 5,200 points. We're a little bit above sort of where we see fair value, so we could see another sort of 3-4% correction in our market. But the same story, we think that central bank policy and low global bond yields continues to underpin equity markets. We think that over the next 12 months, the most probable course of action in equity markets is a long sort of grinding consolidation pattern where we probably look back in 6 or 12 months' time and realise that the equity market hasn't gone substantially higher than where it is. In saying that, on an individual stock basis, there's certain names that still provide value, and there's other names that provide sort of a defensive income characteristic where we can own the assets, collect the dividends and collect the call premium. So on that note, let's go in and start taking a look at some of these top 50 stocks, and we'll do a quick analysis of where we see earnings growth and dividend yields and where we see fair valuation. So up on screen there we have AGK. Now AGK we see as reasonable value down here at $15. It puts the stock on about a 4.5% dividend yield and about 13.5 times forward earnings. AGK was looking at growing earnings somewhere around 8%. That's been ratcheted back to probably somewhere between maybe 1 to 4 or 5% EPS growth over the next 12 months. But around $15 a stock's fair value at around a 4.5% dividend yield. We're happy owning it down here, but around $16 is where we look to sell the covered call. And to be specific on that, it's actually a 16.41 that we've been selling now over recently purchased AGK, and we're going out as far as June on that, so we're collecting an extra 30 cents on that, which effectively is doubling that cash yield out of AGK from around 4.5 up to about 9% per annum, and allowing for some capital growth. But we certainly think, effectively getting out of the stock at 16.70 into the middle of next year really well and truly captures the upside recovery there for AGK. I think longer term, into 15 and 16, AGK becomes an interesting story again, but certainly across the next 12 months, earnings growth seems to be a little muted. Asiano made interesting comments from the company that they saw little growth in the Australian economy that was underpinning earnings. So again, beyond tight cost control, which is likely to deliver about 10% earnings growth over the next 12 months. We have Asiano trading on about a 2.5% dividend yield, trading at about 15 times forward earnings. I think that makes the stock a little expensive for our liking relative to some other names. The interesting thing with Asiano is they have a relatively low payout ratio, I think tracking at around 30%, so there's certainly room there for management to increase the dividend payout. So on a sell-off back down to around 550 or 540, I think we're interested in it from a valuation standpoint, and we're interested from the perspective that over the next 12 to 24 months we could see management upgrade their payout ratio, which will put the stock on a higher yield, and would see a slight re-rating of the share price off the back of that. But our value entry point there's around sort of 530. 540. Amcor continues to perform very well ahead of the upcoming spin-off of the Australian packaging business, which will be renamed Aurora. What we're interested in there is selling off the Australian packaging asset or shares in that asset, and continuing to have exposure to the faster growing emerging market and international side of the Amcor business. At around $11, to put some numbers on this, the stock's trading just on a 4% dividend yield on forward earnings. That's allowing for about 8 to 10% earnings growth. The stock's trading at about 16 times forward earnings, so it is getting expensive, 16, 17 times forward earnings. Our range here is really somewhere between sort of 10.50 and 11.50 is where I think it consolidates. Should continue to perform well ahead of the demerger, and I think even post the demerger there's a strong argument that we would look to increase our exposure into the international side of the Amcor business. AMP, we've seen earnings downgrades here where the market was looking for sort of around 5 to 10% EPS growth. Management's reaffirmed that earnings will be flat in the 12 months ahead, so it really is a dividend or a yield story, and I've spoken about this, and that's kind of been our base case on AMP, as we don't see a lot of growth or share price appreciation in the near term, but the fact that the stock trades on about a 5.5% dividend yield, it provides okay value. But again, we've been looking at other areas of the market. ANZ, the theme of the banking sector was that they delivered reasonable headline numbers, albeit to a large extent the added profit was through low or add backs of loan provisioning. So when you step back and look at the banks, we're seeing modest top-line revenue growth. We've seen high dividend payout ratios where they're now sitting at the upper end of the band, mostly between sort of 70 to 80% payout ratios, which is at the historical high levels. We're seeing the underlying earnings being supported by add backs or low provisioning of bad loans, and that's just a feature of, I guess, the economic climate where at the moment impaired loan is at historical low levels for this cycle. And I think sort of what that means is that in the absence of a real acceleration in loan growth, which we think at the margin will start to come through over the next year or two, I just think that for earnings growth across the next 6 to 12 months for the banking stocks will be reasonably muted, given that the valuation of the banks already are trading on historical high PEs up around 14, 15 times earnings, and we're seeing dividend yields compressed down to the low end of sort of that 5% range. Combine that with a backdrop that we are still in the camp that we think synchronized global GDP will occur over 14 and 15, and we should see increased consumer confidence, increased business lending. I still think the Australian banking stocks provide a good buying opportunity. They're a little out of favour at the moment, being that ANZ, NAB and Westpac have just gone ex-dividend. So I think any sell-off that we see over the next days or weeks is a buying opportunity. Anywhere sort of down around this $30 level becomes interesting again for ANZ, and we're certainly happy to continue accumulating the banks at or near these levels. APA not doing there at the moment. ASX, I've spent a fair bit of time chatting on this. We're looking at pretty flat earnings growth across the next 12 months. The stock's starting to trade on a very high PE, up at around 18 times forward earnings, compressing down to sub 5% dividend. When you look at the market volumes, we've seen cash equity value on average over the course of the October period was around 3.7 billion, which was about 10% below the same time last year. So I've spent a lot of time chatting on this with ASX, where we're seeing equity volumes at low levels, but we're seeing the derivative market and derivatives aspect of the revenue streams of ASX providing good growth. The real story here for ASX is there's a little bit of takeover premium coming back into the price, and I suppose some optimism around where we see global GDP growth over the next 2 or 3 years that should continue to underpin ASX. It really is a yield story. We're not seeing a lot of earnings growth in the immediate future, and up here at around $37, I think the stock's pretty expensive, even on a yield story. So our strategy's been we own it at lower levels, and we've been selling calls up here around the $37 level out into the early part of the new year. The European, we're effectively getting $1 for those, which is giving us an exit price of around $38. Plus we've got the upcoming dividend in the February-March period there. So we're really getting an effective exit price ex the div up here at around $39, which more than captures the upside recovery there for ASX over the next 6 months. AZJ, we continue to like this name. It is trading on an expensive PE, and we don't become aggressive buyers of it again unless we're to see a pullback around the 450 range. But the market's looking for around 20% EPS growth out of AZJ over the next 12 months. BHP, our strategy here is we own the stock at lower levels. We've mostly sold covered calls up at around the $39 to $40 range. I think that captures the upside recovery. We've always been supporters of BHP on the basis that analysts were underestimating the earnings growth for BHP. We had a target of around 10 to 15% EPS growth, and I think BHP seems to be tracking in that light. Combine that with the fact that they're winding back their capital expenditure, and there's an increasing prospect that we may see either capital return to shareholders or increased dividends. I think sort of BHP remains reasonably well underpinned. Iron ore prices are holding up better than a lot of analysts had expected, and again at around $40, $39, $40, it puts the stock on about 14 times forward earnings, and it puts it on about a 3.5% dividend yield. We think that sort of captures the story for BHP for the months ahead. Brambles, so we've got the upcoming spin-off of the recall assets, albeit it needs to go to shareholder approval. Our strategy here is to own the stock at around $9.50 to $9.75. It looks pretty expensive. That puts it on about 18, 19 times forward earnings and about a 3% dividend yield. So our strategy here is we really think it's largely going to trade sideways, but a combination of owning the stock, selling the covered calls, we're driving about 10% cash flow out of it and allowing for some capital growth. CBA pays its div in February, so that you would expect some money to start rotating out of Westpac, NAB and ANZ into CBA. However, it is expensive. Probably out of all the banks, CBA provided, I think, probably the least optimistic sort of growth outlook, and yet it's trading on the highest PE across the four major banks. Somewhere back at around $74, I think the stock will be very well supported. So I'm not seeing any significant risks. It really is just the case that the market's had a great run, and do we see a 3 or 4% sell-off? If so, it provides a great buying opportunity again. But specifically with CBA, we're getting now down to a dividend yield there of approximately sort of 5%. We're just tracking marginally above sort of that 5% range. Coca-Cola, so I've spoken on this one. We saw the company downgrade earnings outlook. We think it is valued down here at around $12, trading on about a 5% dividend yield. The strategy here, and we've been recent buyers of it off at this sort of $12 range. I can't see it doing too much more than at best tracking up to around $12.50, $12.75, which will put the stock back on a 4.5% dividend yield, and I think it largely bumped sideways there. We need to see more comments out of the company around cost control and better top-line revenue numbers, given that we saw a combination of both not only falling revenue but falling profit over the last 12 months. CFX not doing anything there at the moment. Computershare, so again we own this at lower levels. We've sold the covered calls at around the $10.75 level, giving us an effective exit at around $11. I think Computershare is a good business in this point of the cycle. It certainly just gets expensive up here, trading at around 18, 19 times forward earnings on a 2.75% dividend yield. I think it's hard to support a valuation much above where it is. I think fair value is back at around this sort of 10.25 level for us to become buyers of Computershare again. But this is one of those names that I expect to be reasonably well supported. It should move sideways. We're owning the stock at lower levels, selling the covered calls, getting around a 10% cash flow out of Computershare on an annualised basis, and having the opportunity to deliver some capital growth there. CSL, we're looking for around 10 to 12% EPS growth in the 12 months ahead. The stock is expensive from a forward PE standpoint, trading up at around 20 times earnings. The company has $900 million worth of shares that it's buying back at present. Expect the share price to be reasonably well supported still. Not doing there in Crown nor in Dexus. Fortescue, I think for our like, is just starting to get a little bit expensive. We're pretty bullish on Fortescue and iron ore prices at lower levels, but up around these levels we start to look to take profit on Fortescue and keep our exposure to BHP and Woodside Petroleum predominantly. Fox, we've seen reasonable numbers out of Fox, where we're seeing strong sort of top-line trends for the cable network programming in the US, where revenues were up around 12% and advertising revenues continue to prove quite resilient. So I think that forward outlook for earnings growth of around 8 to 10% in Fox is intact. the story here is that the company's buying back $4 billion worth of its stock, and any sell-off should be well supported as a combination of A, exposure to the faster growing US economy, and B, that the company's doing this share buyback should continue to underpin the story for Fox. Goodman Group, at around 4.25 yield down here, the stock was looking attractive as it compresses up here with only sort of around 3 to 5% EPS growth in the 12 months ahead. I think the stock looks pretty expensive. Expect it to move sideways. GPT, now we've seen GPT come in and win the bid for CPA. It's not unusual when the acquirer is paying a slight premium that we see a short-term sell-off. But I think ultimately once the acquisition goes through, I'd expect GPT to consolidate at around a 5.5 to 6% dividend yield back at around sort of this 340 level. The stock should be well supported. So I think we'll sort of look back and see this as a base and ultimately look to see GPT trade a little bit higher. But given that, again, that the yields are reasonably compressed already in some of these property trusts, I really think they're in sort of a 10% trading band where they might pull back again during market weakness, find support sort of 3 or 5% below where they are, but really resistance back up here around 380, 390 in GPT, and I think that sort of captures the story over the next 6 to 12 months. IAG not doing it there at the moment, nor in Iluka. IPL just came out with their earnings result. It was marginally ahead of expectation. The dividend was slightly below. I think the real story here is that IPL's doing a good job of controlling costs in the environment where the margins for their products have been under pressure. We have it on about a 4.5% dividend yield, trading at about 13 times or around 12 times forward earnings. I think relative to other areas of the market, the stock's reasonable value, but there's certainly not the short-term impetus to really push earnings substantially higher. I think if you go out to 2015 and 16, that's a different story. I think IPL continues to perform well on a sort of 2 to 3 year outlook, and we'd look for the stock to find support down at these levels. Lend-Lease. So you've probably seen in the newspapers there's been commentary around Lend-Lease saying that their forward development pipeline is at historical levels, which should bode well for earnings growth. We've seen management come out and say that they think that the company can deliver 10% EPS growth over the next sort of 3 to 5 years. That is coming off an environment over the last 12 months where Lend-Lease hasn't delivered substantial earnings growth. At around 12 times forward earnings and around a 4% dividend yield, I think the stock should be well supported on a pullback, maybe down here to around $10.50. I think the range is sort of $10.50 back up to $12. I think Lend-Lease is probably one of these unique stories where there's a strong case to be an acquirer of Lend-Lease on any sell-off, and we continue to look to add Lend-Lease to portfolios over the next sort of 6 months, with a view of it probably being a name that marginally outperforms on a 2 to 3 year outlook. MGR, we're not doing anything there at the moment. We did own it at lower levels. We've taken profit up here at around 178, and our preference has been to sort of focus on Stocklands, Lend-Lease, and to a lesser extent GPT right at the moment. Macquarie, so good earnings result on a forward outlook. Macquarie needs to deliver EPS growth of around 20% just to match market expectations. That puts the stock on about a 5% dividend yield and around 15 times earnings. Our preference is to probably more stay exposed to Westpac and ANZ at this point in time. In the case of all the banks, yes, there could be another sort of 2 to 3% sell-off, but ultimately we would be looking for them to find support at or near these levels. Newcrest Mining. So the gold price continued to remain under pressure around 12, bouncing between $1,250 and $1,300 an ounce. I'd spent a fair bit of time chatting about Newcrest production issues. The only highlight is that the production numbers are gradually starting to creep up, but obviously they need to address the high cost of production in some of the, in particular around the Lahia assets. and we're not seeing enough commentary out of management yet as to what a change of strategic strategy is. We're seeing gearing creep back up as a result of the write-downs of assets over the last 12 months. And our case, I guess, for gold is that whilst gold's come under pressure on the possibility of the Federal Reserve pulling back on its stimulus program, we think that central banks in the Western economies still have large debt levels, which will mean that gold will still be an asset that gets increasing allocations, especially from central banks in emerging markets. And we think sort of ultimately maybe around this $1,200 an ounce ends up being support, and on a 2 to 3 year outlook we'll start to see gold trade higher again, which should mean that Newcrest eventually finds support down at these levels and can trade back up towards sort of that $20 plus target over the next couple of years. Origin getting expensive up here around the sort of $14.50, $15 margin, $15 level. The stock trades at around 19 times forward earnings on a 3.5% dividend yield. Combine that with the fact that the company's already indicated that they'll have limited earnings growth in the 12 months ahead. The market's really pricing in here the future growth coming in 2015 and 16 and onwards, but I don't think we're going to see the market pay substantially more for Origin than where it is today over the next sort of 6 to 12 months. So our trading range for Origin is really somewhere between around $13.50 and around $15, but well supported again on any pullback. So it's one of these names that you can afford to own, sell the covered calls, drive around 10% cash flow out of Origin over the next 12 months, but eventually looking for the share price to perform stronger into 14 and 15. I reckon not doing there at the moment, nor in oil search. Our preference is Woodside Petroleum. Not doing there in Qantas at the moment. QBE, I've chatted about this, probably slightly more favourable tailwinds now starting to develop for QBE, where we're seeing on a longer term outlook increasing prospects for interest rates rising in the US, and probably a slightly stronger US dollar, which should bode well for QBE. From a valuation standpoint, the stock trades at about 12 times forward earnings on a 4% dividend yield, and I think relative to other parts of the market, QBE is starting to look more attractive. Rio, so I've spent sort of time on this one as well. On a forward outlook, we're looking for around that sort of 10% earnings growth for Rio. Iron ore prices have held up better than anticipated. We're seeing good production numbers and expansion of future iron ore production coming out from Rio. But again, our preference is BHP and Woodside over sort of more of a single commodity exposure here in Rio. But our price target based on sort of Rio trading at around 12 times forward earnings and about 10% EPS growth, the stock should support a valuation of around $65 to around $68, and that's where we see Rio trading and consolidating. Now, Stocklands, I've spent a bit of time on this. The attractiveness is that it trades on around a 6% dividend yield. It does have a 100% payout ratio. I think the company will probably only grow earnings by about 5%, so at around $4 the stock starts to look expensive. We own it at lower levels. We've sold the 420 covered calls. We collect the upcoming dividend in December, and as far as significantly sort of building a new position in Stocklands at around this sort of 380 level, I think the stock should be well supported. Sonic Health not doing there at the moment, nor in Santos. We've largely taken profit on Santos and kept the oil and gas exposure in Woodside Petroleum. Not doing there in Suncorp, nor in Sydney Airports. Transurban we continue to like coming into the December dividend, albeit with it marginally above a 4% dividend yield at this point in time. I think the range really is sort of $7 to maybe $7.25 resistance. I don't think there's the argument that the stock can push too much beyond that in the short term. So we're owning at these levels, going out into sort of that March to June period in the new year, selling covered calls and boosting that dividend yield from sort of 4% up to 10%, but we continue to like Transurban. Telstra, I think it'll be well supported on any pullback, whether it dips down into this sort of 490 range, which I could see that happening on sort of a 5% correction in broader equity markets. But coming into the February dividend again, I'd expect Telstra to rally back up and trade back up towards that 525 level, which will put the stock back at around sort of that 5% dividend yield. At 525, to put some specific numbers on it, if the stock pulled back to around 490, it puts it back on almost a 6% dividend yield. And we're not seeing, albeit earnings and profit are only growing at very low single digits, we're not seeing any commentary out of the company that indicates that the dividend payout is under pressure. Therefore, at around 490, the stock should be well supported. At around 525, that dividend compresses down to below 5%, and I think that sort of runs into resistance for Telstra. Toll, a little bit of a favourite of the market over the last few weeks as investors tried to get exposure to some cyclical or recovery plays, and Toll's been one of those favoured choices. At around 14 times forward earnings and about a 4.75% dividend yield, the stock's full value at around $6. At around $5.50 it looks attractive, and we're happy to be buyers of it on a pullback at around $5.50. From an earnings growth perspective, we're looking for Toll to deliver about 5% EPS growth in the 12 months ahead. Westpac, so again, in line with the broader market, yes, we could see a 2 to 3% sell-off, but anywhere in Westpac back and around this $31 level, I'd expect it to be very well supported. Puts the stock on a forward PE of around 14 times, a dividend yield of around 5.75%, and I think that's the level where we see money come back into some of these names again. So in any sell-off in the market, we're expecting to be reasonably shallow. Westfield, again, only about 2 to 3% earnings growth in the 12 months ahead. I'd expect to see the stock rally reasonably hard from here off the back of the company continuing with its share buyback, and we have the stock trading on a div yield of around 5% down here, and I think that's reasonably attractive given sort of the forward growth outlook for Westfield. So for new money coming into the market, happy to continue to acquire Westfield at or near these levels. We've seen Wesfarmers pay out a special 50-cent dividend. Up at these levels, it puts the stock on a PE up at around 19, 20 times earnings, which on forward earnings, which is very expensive and compresses the dividend yield down to around 4%. So even though if you look at sort of the historical earnings growth of the company coming back from around sort of 10% back down to around 6% EPS growth, if we look at that on a forward outlook, again allowing for around 6 to 7% earnings growth, we're already paying up at these levels around 19, 20 times earnings. So our base case for Wesfarmers is the stock will be very well supported, given that it does have a defensive earnings outlook, albeit I think the range for Wesfarmers probably is more sort of between sort of 42 and maybe as high as $44, but it should in theory run into resistance at levels close to where it is at the moment based on that very high forward valuation. Worley's not doing there at the moment. Woolworths, so from a valuation standpoint, Woolworths is trading at about 16 times forward earnings, getting down to about a 4.25% dividend yield at around $32. I think that provides sort of a deep value proposition there as the dividend yield would start to get closer to around 5%. I think Woolworths can grow earnings at around 5 to 6%. And the range for Woolworths becomes support down here at around 32.50, resistance back up at around 35.50, and we largely see it sort of bouncing sideways. So again, a great name to be sort of accumulating at lower levels, selling the covered calls, driving that 10% cash flow out of it. and benefiting from the stock largely moving sideways. Woodside Petroleum, when the stock was trading up at around $39, we took the opportunity to sell the covered calls up at around sort of this $40 level. Again, combine that with the 6% dividend yield, we're driving sort of around 12% cash flow out of Woodside on an annualized basis. We don't think the stock trades too much above this $39, $40 level. Somewhere down here around $38.50, it's a good buying opportunity, and up at around sort of that $39, $40 range is a selling opportunity. From an earnings growth standpoint, we're looking for Woodside to deliver about 8% earnings growth in the 12 months ahead. Westfield Retail at a 6% dividend yield, very little earnings growth. I think, again, this is one of those names that just largely bounces sideways. So we own it at or near these levels, and we're selling the covered calls up at around $3.20. And to conclude today's recording with a short-term market outlook, up on screen there's an index of the top 50 stocks. So broadly speaking, we think that, yes, the market could correct maybe 3%, 5%, but given that the central banks are continuing to provide stimulus, given that we do see synchronized global GDP growth into 14 and 15, our base case is that on any sell-off, equities are very well supported, and we're probably in for a period of consolidation over the next sort of 3 to 6 months, which should provide a good backdrop to own sort of defensive equities, some exposure to growth through some of the US earners, and also owning the defensive names and selling sort of tight covered calls. BHP, Woodside Petroleum, still providing opportunities for growth. The likes of Amcor, Brambles, we continue to like, albeit recognising that they are starting to get on pretty expensive PEs. Thank you for listening in. I look forward to speaking again next week.